Let's face it, your CPA does not understand influencer taxes. If you're a content creator, YouTuber, on Instagram, TikTok making money, and you're still using your personal name to do your business, you are likely losing out on thousands to taxes. Most CPAs don't understand how to work with influencers because it's kind of a new industry. But today, I'm going to share with you 5 powerful tax strategies you can use right now to keep more of your hard-earned money in your pocket. And stay until the end for a surprise strategy that could save you tens of thousands in taxes and make you a lot of money too. If you want more tax tips like these, hit that subscribe button and turn on notifications. Now let's get started. First up, stop operating under your personal name. If your income is growing, it's time to form an LLC and elect for it to be taxed as an S-corporation. Here's the reason why. When you are a sole proprietor, not only do you pay taxes to the IRS and to your home state, you're also paying up to 15.3% in self-employment taxes on top of all of that. But with an S-corporation, you only pay that tax on the salary that you pay yourself, not the entire amount. And so it's very, very important to make sure you're in the right legal entity earning that influencer income. Let's say, for example, you make $100,000 a year. As a sole proprietor in your individual name, you're paying over $15,000 in self-employment taxes alone. And again, this is on top of the income taxes you pay. Now, on the other hand, if you formed an LLC and have it taxed as an S-corporation, what you can do is pay yourself a reasonable salary, let's say $60,000, and take out the rest of the money, $40,000 of it, as owner distributions. In this scenario, you're only paying payroll taxes on the $60,000 of payroll, and you could save up to $6,000 in taxes. So as you can see, the more money you make, the more taxes you're potentially saving by operating as an S-corporation rather than your individual name. So if your income is exploding this year, this is a no-brainer to consider. Next, let's talk about tax write-offs. Too many creators miss out on big tax savings because they just don't really know what they can write off. Think about camera equipment, props, staging, business use of your car, working out of your home office. These are all common expenses that could be legitimate business deductions if they're ordinary and necessary for your content creation. Here's the catch, especially for influencers and content creators. Don't blur the lines between personal and business expenses. So a trip to Hawaii might be deductible if you're filming content, meeting with clients, meeting with vendors, or attending a conference. But if it's just for fun and you happen to capture some pictures that you use for your social media, then that's not a business deduction. So plan ahead, make sure you document all the business purposes, make sure you track your expenses correctly, and that way you can maximize your tax write-off without triggering the IRS or worrying about potential audits. Next, make it a family business. Here's a secret strategy that most people overlook. Hire your family members. Yes, you can legally pay your kids or even your spouse or your parents for helping out with your business. Here's an example. If you have a teenager who helps edit your videos or manage your Instagram captions, pay them a reasonable amount. In 2025, you can actually pay your child up to $15,000 that's tax-free to them and a tax write-off for you. So if you're in the 50% tax bracket between federal and state taxes, this will save you up to $7,500 in taxes. And think about it, this is money that you were just giving away to your kids anyway, so why not help them by giving them a job and take a tax deduction in the meantime? Now, the key here is that you have to pay them a reasonable amount for the work that they're doing for you. And the work does need to be related to your business. So if you're paying them for household chores and things like that, that's not gonna be a tax write-off. Make sure they're helping out in your business. And if your spouse helps with administrative tasks, let's say customer engagement or appears in your content, you could potentially hire them and open the door for extra tax write-offs like business, travel, meals, and even massive retirement contributions as well. Speaking of retirement, don't just work hard for your money, make sure your money is working hard for you as well. So if you don't have any full-time employees, consider opening a solo 401k. It's super simple to set up, and in 2025, you can potentially contribute up to $70,000 towards your retirement account and get a write-off for that entire amount. So instead of paying taxes to the IRS on $70,000, you're instead putting that money towards your own retirement. And even if you have employees, you could still use the same strategy. It would just be a regular 401k instead of a solo K. Now, if your spouse works for you in your business as well, you could potentially double the tax savings. So if we're talking about $70,000 for you, that could be another $70,000 of retirement contributions for your spouse, depending on how much income they're making. At a 50% tax bracket, that could be a tax savings of $70,000. Last but not least, this is my favorite one, use real estate to grow wealth and save on taxes. This is the big one that most CPAs never mention. What you can do is buy a short-term rental, and when you do it correctly, you can actually use that short-term rental to not just create income, but also offset a ton of your income from your influencer business. So why real estate? Well, just like how equipment lose value over time, real estate has wear and tear. And so for that, we can take depreciation on the building. And so the depreciation write-off is a paper write-off that you can use to offset the income that you generate from the rental. Now, if you're looking for different properties, think Airbnbs and Verbos. When you actively manage a short-term rental, you can potentially use some of the same strategies used by the super wealthy to create tax losses. And these losses can then offset taxes from your influencer income and allow you to keep more of your profits. The key here is you have to meet material participation hours. For example, if you buy a $500,000 property and strategically create $100,000 in tax losses through depreciations, writing off the furnishings, you could reduce your taxable income by $100,000. And again, if you're in the 50% tax bracket, it could save you $50,000 or more in taxes. Now, to do this correctly, you need to be doing the right things to meet the IRS required hours. So don't do it alone. Work with someone who understands this tax loophole, because this is one that's missed by investors everywhere and even CPAs. Now, if any of these tax strategies are new to you, be sure to browse my YouTube channel where I go in depth into all of these strategies in detail. And remember, it's not about how much money you make, it's about how much of it you get to actually keep and how hard that money works for you.